Welcome, everyone. I'm Angelo Robles, host of the Angelo Robles podcast on Apple, iHeart, Spotify, Stitcher, and other platforms, and founder and CEO at FamilyOffice Association, a global membership organization dedicated to families of great success and their family offices. I help global families and their family offices solve problems, procure positive future outcomes, and prepare for intergenerational necessity. It's vital for the families and their family offices to understand vulnerabilities and become more resilient and anti-fragile so they can thrive in crisis. My experience with some of the wealthiest families in the world has allowed me to distill best practices for discovering purpose, in creating vision, governance, structures, systems, processes, and culture that will allow your family and their safeguard family office to thrive. I help families create and reinvent their family office to be of institutional quality, adaptive, and nimble. My process engages all generations in the family and in designing fluid, generationally dynamic family office for people, systems, and technologies that thrive and challenge and are aligned with the desires and capabilities of the rising generation. Today's podcast is titled Venture Capital and Disruption of the Investment Management Industry. We're very fortunate to be joined by, back in the day pre-COVID, one of our frequent speakers and one of our most highly rated speakers at Family Office Association, and that would be David Teten, CEO of S.O.P Ventures, a venture capital fund. He was previously a managing partner with HOF Capital and partner with FF Venture Capital. He regularly writes and very talented. He's a great writer at Teten, Teten.com. David, welcome to the show.
Thank you for having me.
It's a pleasure. We have so much to discuss. And I was mentioning during COVID, on the investing front, probably the most common alternative or asset class that we've covered has been venture, because I think the opportunity now is so disruptive. We're living through it at COVID. Kind of what was going to happen is happening right now. It's being accelerated. So to me, earlier stage investing to even later stage venture investing, I think is a tremendous opportunity for families and the generations in their families. A little bit like what I noted in my open, where I mentioned that word generational quite a bit, because I think that's really important for sustainable families. And this is usually a topic, especially with the younger generation, that tends to engage them. David, I'm going to start with you with a little bit of a question that I don't normally lead with, but I think with your background and what you do is so unique, I am going to change course and lead with it. And that is, there's so many venture capitalists out there. What is unique, or may I even say unusual, about what you've launched with S.O.P?
So I've been a VC for 9 years, and I designed S.O.P to take advantage of some of the changes I see as a result of 2020's many disruptions. First off, I've designed the firm from the ground up around using a sophisticated internal tech stack. Most VC and private equity firms have very limited use of technology internally: Excel, Salesforce.com, CB Insights, and I'm thinking through at every stage of the investing process, how can you use technology to make better investments? And for those interested, I've published a 5,000-word white paper around how, in general, investors in private markets can do a better job using technology. I've also designed the firm to use an alternative VC structure, which allows founders optionality. Usually when a VC invests, you're effectively forcing the founder into a certain predetermined path, which is, in most cases, raise more VC over time, right? Because it's in the VC's interest to do that. So you get markups, paper markups, because liquid exits take longer. And that's great for a certain type of company. But the vast majority of successful companies in America, including, I'm sure, most Family Office Association members, did not raise VC, right? They raised money by having profitable businesses and growing organically. They might have used debt or other structures, but they retained control, which is often how you create wealth. So the investment structure that I typically lead with gives the founders flexibility to raise more VC if they wish, or to buy me out over time at a fair multiple for all parties. And lastly, I'm launching a community for founders in transition, founders who are researching their next move after they've had an exit, called Founders Next Move. I find that once you've been a founder, and this is very much from my personal experience, you're not really employable, right? Because people say this is clearly someone who wants to go build something. So that's good and it's bad. There's this whole population of people out there who had an exit, sometimes a big exit, sometimes a small exit, sometimes they shut down the company, and they're figuring out what to do next. So I'm creating a community specifically to serve those founders, and I'll end up investing in some of them, and they're all going to be people who are going to be assets to the firm.
And you mentioned the 5,000-word white paper. I read, and you've updated it since then. That paper is fantastic. It's one of my favorite reads in the community. Later on, David will impart his information where you could learn more and perhaps reach out to him. And again, that paper gets my 5-star approval. It was fantastic. How can members of my audience, whether my live participants or those that view or listen to this in the future, often with operating backgrounds, work with and earn money? And I know that's a unique question, but within the VC and private equity community.
So in a former life, I was CEO of an expert network. My competitors included GLG and the other firms in that space. So I'm very familiar with being an intermediary between operating executives and the investment community. There are a number of ways that operating executives can work with people like me and more broadly the investment category. So the first and most obvious is register on the major expert network sites. Doesn't cost you anything. Make sure your profile is keyword enriched, meaning type in all the companies and industries that you're familiar with. And you will find investors reaching out to you to interview you about your areas of expertise. And by the way, I have a deck on my website, teten.com/OE, where I list all the major expert networks and other categories that I'm about to list. Another category are the consultant networks, companies like Catalent, which are typically helping people find longer-term consulting assignments. And that might be service on considering expansion to a new business or new geography. Another category are deal executives. And this is an area where I think the family office community may particularly shine. If you have an idea for buying a business, but you don't have the capital yourself to execute that transaction, there is a universe of PE funds who want to back you, right, and slot you in, if you're the right fit, as CEO or in some other role, and they'll compensate you for sourcing and helping to execute that particular transaction. Another model is to serve as an executive in residence or entrepreneur in residence at a fund. As a VC, we have this program where an EIR leverages our network. We help support them as they research different startups. And when they raise, we, of course, expect that they'll come to us to ask us if we'd like to invest. But there's no obligation, right? They're not signing anything contractually to do that. They have to like us, and we have to like them for us to want to work together as an investor. Similarly, in the private equity world, some PE funds will back you as you might look for companies to buy. And lastly, of course, you can go and get a job at a private equity or VC fund or found a VC fund, which I can talk about more if that's of interest.
Yes, it is actually. Towards the end of our discussion, I'm actually going to ask you about families of wealth creating their own VCs, and I'll give you context to it at that time, but we'll leave the audience hanging a little bit on that one until later. I really enjoyed asking you that question, and a little different than what I've asked other angel and VCs, because I think, again, in reading your white paper and all your work, that you would have great insight that would be pretty deep on that. One of the ways that you just described, and I believe some people call it a search fund. So if you could talk a little bit about that hungry entrepreneur that sources opportunity. It might even be an earlier generation or a rising generation in the family, and that brings that opportunity to bear and has an opportunity to be engaged in the compensation and ownership structure. If you could talk a little bit about how search funds work.
Sure. So the typical search fund is started by someone who's, most of the time it's someone who's recently out of business school, although that's certainly not a requirement. They raise a very small amount of capital, it might be $200K, and it pays for living expenses and a modest salary where they go look for a company to buy. And this typically takes 2 years. So you need to budget for a long search process. And then once they buy the company, they typically slot themselves in as CEOs. This was popularized initially by Stanford Business School. It's now well known enough that there are a couple of funds who specialize in investing in search funds. Once you find the company you want to buy, then you have this pool of capital teed up to back you. It's sort of like a micro version of a SPAC, ironically, with
Yes.
SPACs being very much in the news now. So it's a great fit if your goal is to be CEO of a company and you're willing to go 2 years, if need be, to go find a company. You have no guarantees, right? You may spend 2 years and not actually find something, and then you really have nothing to show for 2 years of effort. And that certainly has happened in the search fund world. But the great thing about it is you have flexibility to find the exact right company. There are lots of deals out there, right? But if you want to go and be a principal of the company, there's only a small number of companies that you realistically are likely a fit to be CEO of based on your personal background, expertise, geography, et cetera. So this allows you to zoom in on a company that is a fit for your particular skill set, finance it, and then go to work building it. And there are numerous case studies of people who at a very young age have been able to go do this, leveraging infrastructure. For some in the FOA community, that might be your family. But what I like about it is there's a very big difference between your family financing you when you take over a separate company and then just joining the family business. So if your goal is to carve out your own path, right, and not just join the family business, and lots of next gens, that's certainly a goal, this is a way you can accomplish that goal.
Yes, and that was a great overview of it. Off the top of my head, and hopefully you'll correct me, the professor at Stanford about 20 years ago, maybe more, that popularized it, Professor Irv, and his last name, it was a unique name. I don't even want to take a guess, but yeah, he's fantastic. And that is a subject we'd like to do a deep dive into one of our future videos and podcasts. I find it to be intriguing. A little bit more traditionally now, what are some of the best ways to identify and originate investments in the illiquid markets?
So let's talk about it from the perspective of family office, because my answer would differ if you were asking from the perspective of a P fund or VC fund. So from the point of view of a family office, there are a number of marketplaces like Axial that are making it easy for you to search for given private companies. But
Sure.
The challenge with any marketplace, of course, is it's more efficient, right? That's their whole sales pitch. And that implies that you're at greater risk of suffering the winner's curse. So my first question to any investor is, what is your unique comparative advantage, right? When I get a company or an investment opportunity coming across my desk, why is it coming to me? If it's some random person who wants to raise money for their movie about life in Los Angeles, I have absolutely no expertise. I'm not going to invest, right? Because I'm just not that guy who invests in that sort of thing. So what you want to do is make sure that the investment community knows what you specialize in, because then you will get deal flow in that space. And the more educated people are about you, right, the lawyers, the accountants, the consultants, the conference organizers, all those folks, then they will have their ears open for you because they all want to see transactions happen. It's in their interest to do so. I certainly have met offices that say, I'm a generalist. If you're George Soros, you can get away with that because Soros has specialists on staff for everything. Most of us can't say that credibly, right? So I think if you're not an expert, you should just invest in a fund and delegate to someone who knows what they're doing, and then pick out some areas where you are an expert and look for direct opportunities in that particular vertical. I think an area where there's a lot of room for most investors to do better is use of technology, which I referenced earlier, and let's zoom in on the most ready example of that, which is social media. This is particularly a challenge in the family office world because most family offices, understandably, keep a low profile. But what I find is in the private equity world, where they don't have the same kind of cultural and safety concerns that a family office does, most private equity funds are not aggressive about using different social media channels to evangelize their investment mandate, and there's no reason not to. So by sharing your thesis in the form of your industry analyses, your speaking at conferences, in social media, chunking up your content as appropriate for distribution on different channels, you're going to increase the reach of your brand to all the ecosystem players who may be able to source opportunities for you and effectively act as unpaid employees for you.
And based on your research, what are the most effective ways that VC and PE funds are helping to increase portfolio company value? It's not just their investment dollars. You would think their Rolodex, their experiences could help those entrepreneurs grow and scale their companies once they show that they have some traction.
Right. So a very common need that companies have, no surprise, is capital. So I built the platform function at my 2 prior VC firms, and that meant that we built relationships with later round investors and then helped prepare the companies to tell their story effectively to the later round investors. So we're unpaid investment bankers for all of our companies. I think that's an extremely important function.
Yes.
Another critical function is talent, right? What do companies do with the money you give them? The number one thing they spend money on is almost always talent plus lawyers. So we look to source talent for them, ideally from within our community. A good role model of this is Welsh Carson, a prominent private equity fund. On their website, they say 40% of our portfolio company management previously worked at another portfolio company of ours. So they're like a synthetic GE, right? If you get a job as a controller at one of their companies and there's no room for promotion to CFO because the CFO is 35 and not going anywhere, they'll help you find a job elsewhere in that community, and that enhances your career prospects, and that makes it more attractive to work for them. So that model is something I really respect and something I've built out at my prior firms, and we'll be doing at S.O.P as well. Lastly, I'll highlight the S.O.Ps, Standard Operating Procedures, and that's why I named the firm S.O.P, is there's lots and lots of challenge in building an early-stage company. Your job is to be creative, right? Because someone else out there has already done most of the business models, most of the technologies that one could reasonably monetize, right? My default assumption is a lot of smart people out there, a lot of people who've tried different permutations, right? Why are you going to be successful? You've got to be doing something different than what's out there. So you should focus on what's different, but everything else, I don't believe in being creative, right? You should try and learn from how other people have built out their recruiting function, built out their sales function, and learn from them, because you're going to be more efficient at zooming in on your differentiation where you're trying to really do something unique.
And you did touch on the utilization of social media by commercial firms, and I do think a lot of them have done that very well. Privacy could be an issue with family offices, but in general, you're starting to see them, open up the kimono a little more, and they're going to have that opportunity. And we'll get into a little bit them creating their own VC, whether it's internal or commercial, like I said, a little bit later. But how else are VC, but I guess even PE firms as well, utilizing, and maybe more so now during COVID, like I said earlier, what was going to happen is happening now. It's being accelerated. How are they using technology internally? And how is that perhaps helping them do more with less and scale their investments quicker?
So if you look in the public markets, there are a small number of extremely successful funds, think Renaissance and AQR and D. Shaw, that have used technology and analytics to become extremely, extremely successful. In the private markets, there's a much shorter list of much smaller funds that have had success in using technology and analytics to become better investors. I point to GV, to Signal Fire, a number of others that are doing creative things in this area. So in the public markets, if you look at the total calories that these large hedge funds use for technology analytics, most of it is around origination. I call it origination in my industry. They would probably call it trade selection, right? But that's because most of the stages of investing in the liquid markets are relatively commoditized. You literally can press a button and trade 100 million of stock, right? I can't do that in my world, right? So at every stage of investing in a private company, there are ways to use technology to be more effective in how you originate, and how you do diligence, and how you execute the trade, how you add value to the company, and then hopefully how you exit the investment over time. So I'll highlight a couple of ways that are particularly impactful for using technology analytics. On the origination side, a lot of this industry is driven by networks, meaning people just refer deals to you. And I referenced that earlier, right? We have to acknowledge that's the way the industry works. But of course, it's super inefficient, right? You can't possibly have trusted relationships with all the relevant ecosystem players. Relationships don't scale, and they're also harder to build in a COVID world. So I certainly recommend the use of some of the online databases like CB Insights and some of the data aggregation extraction tools like Relationship Science that can identify companies that might fit your particular mandate and reach out to those companies. There are also a host of service providers which will do this for you for a fee, acting as buy-side bankers with different types of fee structures, of course. Another area where I think you can add a lot of value is on the talent side. This is particularly important in the VC, right, because the gating factor for so many tech companies is high-quality engineering talent. If you can systematically and efficiently move talent around the portfolio, that's a way to add value. Another area of focus for us as we build out S.O.P is going to be use of technology for tracking performance of the companies. One of the challenges in our industry is that contractually, of course, we have the right to performance data about the companies, but these are small companies, right? They don't have the sort of financial systems of a publicly traded company, of course, nor should they. So we have to be quick and efficient about getting the data into our systems so that we can then track the portfolio over time, track metrics, look for problems, right? What companies are running out of cash, showing unsustainable burn, et cetera, so that we can address those challenges as appropriate.
And a little bit more broader industry questions that will narrow down to some more micro questions as well. Broadly, the VC industry, and maybe I'm going to lump in angel investing into earlier stage VC, dominated by the United States. You have somewhat of some inroads by China and Israel and other pockets around the world. But if there's one thing that America shines at, it generally is that sense of entrepreneurship, of doing your own thing. And we have wonderful universities. We have people from around the world that come here and used to stay here and start great companies. It's a little bit of a unique dynamic now. So I did a meeting with about 10 of my members and about 20 Australian families a week ago when we were talking about investment allocation. And my US families, although they vary, but some had very little, but a lot had, I would say, about 7 to 15% in venture capital. And they were excited about putting more in and COVID disruption, all of that. The Australian families were heavily real estate centric and were very weary of technology or VC. Are we just more aggressive investors in the US? Not just that we have more entrepreneurs in VC, but do our LPs or our $100 million families, do they tend to be more active than other investors in other parts of the world? Has that been some of your experience or no?
A couple points. First off, it's universally recognized that China and more broadly the rest of the world, ex-US, is growing in economic weight relative to the US. So it's inevitable that the rest of the world, ex-US, will grow in many categories, including VC, right? That was predictable a decade ago as you saw China start to really bloom. Second is that Nick Kristof wrote an essay recently in the New York Times about how America likes to think we're number one, but on many metrics, we're not. Bill Gates said something really insightful a number of years ago. He said, 20 years ago, if you were a young Indian or Chinese person and you could live anywhere in the world, you'd go to the US, right? Mm-hmm. For a whole host of reasons. He said, now, not true, right? There are many reasons why you might want to stay in India and China, New Zealand without COVID, right, and other countries. So I think we are not as attractive to the best talent in the world as we used to be. And the best talent drives, of course, the highest potential companies. And I think we're resting on our laurels, right, if we think that we can just sit there and presume we're going to continue to be a leader in tech. That said, the U.S. certainly has many advantages as a country, particularly with regard to entrepreneurship. I can't tell you the number of conversations I've had with government delegations from France and Canada and other places saying, look, we've got great engineers, got great talent, and we just don't have anything comparable to the U.S. or Israel or China. And I'll highlight one thing in particular most people don't recognize. One of my professors, Amar Bideh, did a research paper on why the U.S. is a leader in entrepreneurship. He says it's not just the founders. It's the companies that buy from startups. In most countries, large companies are extremely hesitant to buy from unknown suppliers until they've become quite scalable. But in the U.S., many large companies have programs specifically to seek out new vendors. And that's revenues, right, for a small company. You've got to have those companies. And that is a big advantage, that there is a receptivity to innovation, new ideas that many other countries lack.
And a little bit of a shameless plug, at least my live listeners will hear this. Tomorrow night at 8 p.m., I'm doing an interview with one of the more experienced women founders of VC firm. She's been doing it for decades. It's iGlobe Partners. It's 8 p.m. Eastern time because it's, I guess, 8 a.m. the next day, Singapore time. She's based in Singapore. But one question that I will pose to her that I will effectively pose to you, uh, and this is obvious, but sometimes, I don't know, things get overlooked. You hinted at it. And that is in North America, there's what, a couple of 100 million people. There's multiple billions in all of Asia. And that market is growing so significantly. I think we're letting a little bit of our government's political issues and the issues that we have with China being a communistic country get a little bit in the way of, one, there's Southeast Asia, there's lots of opportunities. And even in China, yeah, the government is communistic, and I have a lot of disagreement on so many issues with them. But there's a lot of entrepreneurs there that are acting very capitalistic. And I don't know if the government somewhat overlooks it, whatever it may be. But there's lots of amazing, talented people: China, India, South Korea, Japan, Indonesia, even the Philippines. It's just obvious that maybe there needs to be better protocol on operations and diligence on investments, although we could argue that till we're blue in the face on startups. It's inevitable. We need to invest more in Asia opportunities.
Yeah, I completely agree. And in fact, I have a particular history and bias of investing in internationally linked companies. If you look at the track record of most VC ecosystems outside the U.S., excluding Israel and China, it's pretty mediocre. But
Right.
if you look at the track record of expats in the U.S., a very, very disproportionate number of the most successful founders in the U.S. are immigrants, right? Most recently, Zoom, which is founded by Chinese immigrant to the U.S. So a very common dynamic I see is companies founded by, say, a Chinese expat. He's here in the U.S., he's a U.S. citizen, he has engineering in China, right, or wherever his home country is, and that's a great combo. Technical talent that's lower cost and more stable, right, and the U.S. market. So I've specifically organized events geared to these sort of international founders, and I hope that trade wars notwithstanding, we will continue to see these. This is certainly one of America's long-term advantages, is in China, 99.9% of the economic powers are people who are native Chinese. That's not true in America, right? We have people of all races, all immigrant statuses who are in positions of power, and if we play it right, we can continue to be a magnet for people from all over the world.
Yeah, towards the end, and I know I keep on pushing some things like creating a VC and even some political issues we're going to talk about later. And we are not a politically correct organization. I wear a little bit of my beliefs on my sleeve, and I encourage other opinions and people to have open and honest dialogue, especially during an election year. And not be limited because it's politically incorrect or one side or the other. Both sides often make sense, and it's good to have some clash of opinions, and maybe you're able to learn something. We're going to get to that a little later. And I bounce around, as you may know, David, all over the place. My next question to you would be a little bit more classic. What returns should angel investors anticipate? Understanding if they're investing really early like angel, most companies aren't going to make it. And do some families maybe not have the stomach knowing that perhaps 8 and 10 investments are going to just zero, nothing?
So I founded Harvard Business School Angels of New York, which is now the biggest angel group on the East Coast. And in the course of doing that, I did a research project on all of the data sets about returns for angel investors. I identified 12 studies of angel investors in the US and UK. We found median returns across 12 different studies of 18% to 54%, right? Which makes it the highest returning asset class on the planet. Of course, there's a catch, right, which has the widest dispersion of returns of any asset class on the planet, and you're probably going to get a big zero on most of your angel checks. So angel investing, direct investing in tech companies, is a great and lucrative thing to do, but you need some very clear prerequisites to do it. You need to have a large liquid bank account. You have to have a lot of tolerance for losses and reserve capital for larger rounds. You need spousal support, right? So your spouse doesn't say 6 years in, no exits and 6 write-offs, right? Are you sure this is a good idea? Perfectly reasonable question for your spouse to ask. You need high risk tolerance. You need patience, right? Average time to exit is 7 years, and there's a huge bell curve, right? In one of these studies, one of the investments took 35 years to exit, right?
Oh my God.
So that can happen. And it takes time and effort, right? the research on this from the Kaufman Foundation shows that the more effort you put into your companies, you get higher returns. Makes perfect sense. But you have to have a time budget to do that. If you don't have that time, then maybe direct angel investing doesn't make sense to do.
And what are the first steps that an aspiring angel investor should take?
So the data shows that angel investors who join groups get better returns than those who do it alone. That was a great thing about HBS Angels. We effectively are a synthetic VC fund, where in one room you'll have someone who's CEO of a public company, we have general counsel of a major bank, right? And a company comes up and people analyze a company based on their wide range of expertise, and that's super valuable. And no one is smart enough to be able to replicate the expertise of all the other people in the room. And the cost is a couple $100 a year membership fee, right? It's nothing. So second is pick out an area of expertise, just as I was saying earlier about family offices. This is coming from your play money budget, great. Go invest in a movie and a Broadway show, right? But if you actually want to get returns, then you should have some thesis and double down on that particular area. Hopefully your thesis is a good thesis. If it's not, then you're definitely going to lose money. I also would look for your thesis to align with your past work experience. No surprise, a common dynamic we see is someone who made their money in, say, real estate, and now they become an angel in real estate tech, and they are a very attractive investor for companies, right, because they come in the door with existing expertise and relationships that can help to accelerate the company. They also have negotiating leverage when engaging with the company.
And what do you think, besides joining organizations that would definitely be a part of it that are angel-centric, but how else to source deals? What do you think of AngelList and other platforms, Axial you mentioned before? I mean, they're all out there. People need to be familiar with them and just jump in and see what works for them?
So I certainly think it's worth digging through those databases and seeing what's out there, especially if you're a novice, right? Someone else has done the work for you of taking all this data, tagging it, categorizing it. At HBS Angels, we use Gus.com, another tool in this ecosystem, and you should go through that to look for companies that are fit. I wouldn't rely exclusively on it if you can, but I do that. I'd also look at Republic.co, which I'm an investor in via an affiliate, which is designed for retail investors and early-stage tech companies. And that's a great way to get your feet wet in this ecosystem and learn about it. If you want to be serious about it and spend 20 hours a week on it, then at some point it makes sense to set up your own proprietary channel, which is less likely to be just those marketplaces. And
it's always a hard question to answer, but I'll ask it anyway. If I lump in angel and VC, what do you think a typical family office should have allocated to that? 5%, 10%, 15%?
So look, the way I manage my personal portfolio is I have a barbell, right? I have low-cost index funds, which is way over on the side of liquid, right? And then I've got investments through funds and direct in a bunch of high-risk, early-stage tech companies, which are super illiquid. And I get offers occasionally to sell secondary stakes, and my answer is generally no, right? Because why would I sell unless I were under a great financial duress? So I think that barbell strategy will get better returns than the more typical strategy, which is you have a lot of cash in the middle, invested in hedge funds and so on, which, as you know, on average don't perform very well and which are guaranteed to charge you high fees. So that's personally how I handle it. But you should always keep in mind that it is illiquid, right? So there's plenty of data showing illiquid assets outperform liquid. So if you can afford it, I would think about making sure that you have enough capital to cover your living expenses, right? Ideally for 10 years or so, so you have plenty of time for your liquid investments to stay illiquid. And then the remainder, my bias is generally towards illiquid assets because of the fact that you will get better on average returns. In other words, that's the same strategy as the Yale endowment, right, which is operating with more zeros than most of us. And it seems to have worked well for them. You can replicate that strategy on your side as long as you're careful to maintain enough of your assets in liquid holdings that you can pay any unexpected expenses that may come out.
And how can angels investors best support their portfolio?
So a highly competent CEO will send out a monthly update telling you what's going on and including a section called These Are My Asks, right? Please help me with X, Y, Z. If they're not doing that, first thing to do is tell them you should do this. And then every month, look at the asks and say, what can I do to help? You'll notice I phrase it as what can I do to help, as opposed to here's how I can help, right? Because, quoting Stephen Covey, right, you want to listen before you speak, right, and understand their particular needs. Sometimes you may need to intervene and say, I really have a question about this aspect of how you're growing the business, and that's okay too. But if you're investing money in a CEO, your a priori assumption should be, I hope, this is a competent individual, right? I shouldn't be micromanaging him or her. I should just be supporting her as she develops the company and providing help on an as-needed basis.
And now, living up, I guess, a little bit to the title that I chose, kind of innovation in investment management. We have speakers and attendees I've had over the years, senior executives at family offices, at wealth management companies. What are threats to their core business that they should be worried about? Now, for an SFO, a single family office, it's unique, although theoretically they're probably, by their operating structure, a for-profit company, but they're non-commercial. But nonetheless, the executives still have to utilize, big data, AI, or should be. So there's an impact to them in the family office, but it probably is a little bit more applicable to those with a commercial purpose.
So a little bit of context here. I have been working on a research study on this theme of disruption of investment management for the past few years. I've collaborated with Katina Stefanova, former management committee at Bridgewater, who I know.
Yeah, she's great.
I know you know, and Brent Beardsley, who's head of strategy for Vanguard. We published a cover story in Institutional Investor on this, and we're going to publish a follow-up soon on it.
And is that available on your website?
You can see the summary of it, and we'll soon release the longer form version.
Okay.
And I'll be in touch with you about that offline. What we did is we interviewed family offices, sovereigns, other large money holders to understand what are their jobs. Clay Christensen, the professor at HBS who popularized the concept of disruptive innovation, said your framework in understanding disruption should be not who are the clients, right? Who are your revenues? It should be what job are you actually doing for clients? So we asked people, we said, what job are you doing for your clients? If you had asked me as a novice VC 9 years ago, what job are people paying me to do as LPs, my answer would be returns, right? They want more money. That is a wrong answer. There are actually a whole host of jobs that investment managers do for money holders. And Christensen showed that disruptive companies often grow by doing one job really well and focusing on that, often excluding a lot of other jobs, and that satisfies a certain chunk of the population, and they grow from that. In finance, the paradigmatic example is Vanguard, right? At launch, most people don't know this, and most people are too young to realize this. When they launched, people said, this is a foolish idea. It took them years to get above 10 mil in assets, right? Vanguard said, we're selling mediocrity, right? Thumbs up. And we're doing it at a low price, and you can be mediocre. And people said, this is the dumbest idea ever. Who's going to pay for this? But Vanguard seems to have had some success and gathered some meaningful amount of assets. I think you would agree, right? So why is that? Because they did a couple of jobs really well. The job of minimizing your costs, awesome. The job of not underperforming the benchmark, awesome. The job of transparency, awesome. The job of giving you something to brag about at your golf club to show how you're smart, terrible, right? No one brags at the golf club about how they're so brilliant, and they got access to the hot new Vanguard fund, no bragging rights. So what I wanted to look at is what are the jobs to be done of a money manager, who's doing those different jobs well, right, maybe to the exclusion of all others, and that's where I think the growth is, and that's where the disruption is. And 40 years ago, right, the big money managers should have worried about Vanguard, but of course they dismissed it as a toy, as a joke, right? Exactly the way that lots of people dismissed Google and Apple and so on when they were baby companies. So the jobs to be done of a money manager fall into a couple of buckets. The first one is strategy, right? You have to generate alpha, you have to not lose too much money, you have to match liabilities and obligations, and so on. And there are a couple of creative companies I'll highlight that are addressing this. So one is ESG, right? So there's an ecosystem of ESG, socially responsible investment companies. And I know a lot of investors, a lot of executives of big investment management companies who say, oh, this is just for the do-gooders, right? This is not a real threat to fidelity. But the reality is, particularly after 2020, I say after, we're still only partway through this year, more people are realizing that actually society does need you to pay attention to it, right? Like politics does need you to pay attention to it. You can't just ignore your social responsibilities. And I think it's a pretty safe bet that money allocated with an ESG mandate will grow over time. And some of those ESG-focused companies will become more significant players competing with the established Fidelities, the established outsourced CIO companies, and so on. Another area that I think is really interesting is people who are planning for worst-case eventualities. Again, after 2020, right, people are more cognizant that really, really bad outcomes can happen. And so for people who are selling gold bars, like actual gold bars, you don't have to worry about title or whatever, but actual gold bars, right? You're going to see more people interested in things like that give you some protection. That's led to, for example, more high net worth families building second homes in New Zealand or in bomb shelters, right? Which is both an investment but also risk management strategy for the family. Another job to be done is the execution of investments, right? You have to, as an investment manager, you have to source ideas, DD them, you have to make decisions, you have to exit them. And I think an interesting company in this space is Bullet Point Network. This is started by Michael Ryan, who's formerly a partner at Goldman Sachs, former board member for the Harvard Management Company. And what Bullet Point Network does is they allow you to quantify the different scenarios that go into an investment decision, right? Usually when you're modeling out an investment decision, you might have some pivot tables, right? Does GDP go up by 1%, 2%, 3%? But there are actually a lot of different alternative scenarios that could impact it. Is there a pandemic or not, right? Do we return to something sort of like normal? Probably not so many handshakes 3 years from now, but no one really knows, right, when this pandemic is somewhat over. But you have to take that into account in your model. So Bullet Point Network has built a tool that allows you to very systematically model out all the different scenarios, apply likelihoods to each of them, and then track over time your investments so that you can update it and make further decisions based on how reality aligns with the story that you told. A third is administration of investments. So I'm an investor via FF Venture Capital in Adipar, one of the companies that's a leader in the space, which provides back office functionality to family offices and RIAs. And Adipar has recently announced that they're launching what is effectively a marketplace for illiquid assets. How did they get into that? Because they were offering back office plumbing, right, to family offices and RIAs. And Adipar was moving up the stack towards other services. So 5 years ago, if you'd asked Fidelity, is Adipar a competitor? They probably would have said no. But now, right, you start to see how they might be something of a competitor. And as Adipar progresses, I hope as an investor, right, that they'll continue to move up, and you could see them getting more aggressively into other services to their client base. So I could go on, but I'll stop there for now. But this gives you an idea of my framework.
Yeah, that's a great framework and relates a little bit to some of the things that you noted, the great, Clay Christensen and his wonderful work. And, like you said, all these companies were sneered at early on. Yahoo probably had a chance to purchase Google early on, very early on. Of course, oh, no, we're the dominant player. You didn't mention in the broker-dealer community a company like Charles Schwab. So these are all things in hindsight, we look at it differently. Oh, yeah, it's a no-brainer. But at the very early stages, it's, of course, way harder. Do you have any thoughts on how to address the fundamental logical conundrum of asset management, an industry in which the players are primarily playing a zero-sum game in regards to returns, as opposed to creating new value? Who in the industry is actually helping investors increase returns without subtracting value from other people in the industry?
So I certainly am going to acknowledge my biases here, but as a private equity VC investor, one of the things I really like about my space and finance is that I can change the odds. When you're investing in the public markets, you put on trade, and then what can you do? You can hedge, you could pray, or you could exit. That's about it, right? But in my world, I can get active on the board, I can recruit new management, right? I can do things to shape the company. In the public markets, Bill Ackman might be able to do that. Activist investors can do that. If you're a really big investor, right, then you might have leverage, take a board seat. But that's not the case for the vast majority of liquid market investors.
Right.
You're 100% delegating management to to the management of that company. You have no ability to change how things happen. So another framework here is the way that a hedge fund creates value versus mutual fund is they're serving somewhat different needs, right? So to the extent the hedge fund actually hedges and doesn't lose as much money in down markets, which is what the industry collectively did, right, during the global financial crisis, right? They lost money, but not as bad as the index funds. And that, right, that's a defense of the hedge fund industry, is, right? They were, on average, able to give some downside protection. That is providing a value for which they were and are compensated. And so the fact that different investors in the market are serving somewhat different needs, right, that goes to some value they're creating. I think another area in which you can create value is if you're creating new industries. And that's the great thing about VC specifically, right, is we're trying to, as an industry, look for companies that take advantage of new technologies, changes in culture, and so on. And that's an area where I think you can grow the pie, not just swap around little slices of pie.
Let's talk about a couple of kind of really big picture plays in technology that I'm sure now, especially during COVID and so much being focused and all these great entrepreneurs. Let's go a little round robin and get your opinion. Advancements in AI, which I guess so far appear to be dominated by the giants. But again, there's always that one upcoming that we overlook. Your opinion about AI and how that could be, let's not get into job loss and all that. We already know about that. That's a little scary. We'll deal with that in some other points and issues. But broadly speaking, is there still opportunities for investors, for family offices to invest in emerging AI technologies?
Absolutely. I have a friend who's a CS computer science professor, and he says AI is defined as anything computers can't do. So 30 years ago, if you had said, we have a computer that can play chess and win against a grandmaster, you just said that's AI. And now we have such computers, right? We have Deep Blue. People say, oh, yeah, that's just pattern recognition, right, blah, blah, blah. If you could beat a player in Go, which is considered much more difficult, right? People said that's AI. Now we have such a computer. People say, statistics, right? Machine learning. So there's always a frontier of new things that AI has not yet solved. AI has a long history of being oversold, right? We are decades from a general AI like you see in the movies, like the movie Ex Machina. I'm not worried about that.
Right.
But there's no question there are certain job functions. Truck driver is a very prominent example. In most U.S. states, I think 48 to 50 U.S. states, the number one biggest job category is truck driver, right? So that job over time will be shrunk. There will be fewer people that job, but there will be new jobs created, which will be things like automated truck maintainer. Someone has to oil the truck, gas the truck, et cetera, because we'll have trucks operating around with drones. So as a family office, the question you ask yourself is, do you actually understand the AI companies pitching you, or do you think it's AI because their domain name is .ai, right? If it's the latter, then maybe this doesn't fall into your circle of competence. And that's something that I think requires introspection on the part of an investor to understand what does and does not fall in their circle of competence.
I think the general perception is that augmented reality and VR has been a little disappointing. It's been hyped for a long, long time. I would like to hope during the times we're going through now, where some of this may be permanent moving forward because it's so more efficient, that remote working does need a layer of some kind of 3D or better, I would call it augmented and virtual reality, online education. It's coming, but I felt like it was probably a decade or more out. Do you think you'll be accelerated?
So we have not seen a boom in AR and VR in 2020, despite the fact everyone's locked at home with their high-speed internet. And that speaks to the fact technology is just not very compelling. In fact, if you look at my Calendly link, which I use to schedule meetings, I say publicly, if it's an introductory meeting, let's have video conference. If not, let's just use the phone, right? Because I, like a lot of people, just find the video conferencing a little distracting because it's not as good as in person, right? If I had a choice of meet in person and a phone call, I would, of course, take a meet in person, but that's not an option nowadays, so I take the phone call. So if you're in the uncanny valley of being not as good as real life, then a lot of people just default to the phone where it is as good, right? Like me talking with you on the phone is as good as me talking to you live, excluding the visual. But the audio is pretty darn good. And that's why I think it's still going to be in this uncanny valley for easily 5 years, right, before it gets to a point where people say, wow, this is as good as the real thing, and I want to do it. You would think, and a lot of investors did think 5 years ago, games would be the winning app for VR and AR, right? Because it doesn't matter that it doesn't exactly match reality. Everyone knows when you play a video game, it's not the same thing as reality. But it hasn't happened. Lots of people still are perfectly happy to use traditional 2D screens. So I'm not as bullish on VR and AR as I am about other areas of technology.
And broadly, kind of a comment relating to what we're just now talking about, but I would love to get your feedback on it. And I've hinted at it all along that COVID has accelerated certain things. My experience, even with rather stodgy single-family offices, is they're kind of finding that remote is kind of working, that it's now as effective. It may not have been early on because people needed to adapt their systems, their technology, and getting used to it. It is definitively more effective relative to travel to and fro, which if you're living in metro areas, you avoid. And again, I can make the argument, I could be a family principal in New York and Florida. I had a family office in New York. Now my talent could be dispersed to where they want to live. It also creates opportunity for me as a family principal to have the world as my oyster of employees. But on the converse of that, it creates a talented executive or family office person the opportunity to live where they want to live and have greater family and personal life. If I wanted to live in the woods of Idaho, but I got great Wi-Fi connection, that'll make me happier. You can maybe pay me less money because it's going to be. So what's happening there is we are noticing the dynamic in the family office, perhaps getting younger generations coming into power, perhaps hiring more people that are native to technology that are millennials. There is that dynamic happening broadly in the wealth management industry. Do I really need to now be a hedge fund manager and I have to be in New York or Greenwich? Those days are gone.
Agreed. I think people talk a lot about VR and AR, but for purposes of having a well-managed organization, that's the wrong topic. I would focus more on text. If you look at the world's biggest remote-first company, which is GitLab, which has 1,400 employees, none of whom work in an office, they are obsessively focused with documenting everything they do in text because that is scales better than video. It's searchable, unlike video. And they make sure that everyone is as transparent as possible in all their internal processes. So that's certainly something I've always hired for, and I'm hiring for more now, is the ability to communicate clearly in writing because I'm engaging with people at every meeting, and we have to be able to interact, and I can't just shout at them down the corridor.
Yeah, that's there's no, First Base is a different company. There's a company that has an iPad-like device where you're remote, and basically it's on 24/7, and you could see the other party, and you could kind of turn your head and talk to them.
Right.
Is it quite the same as face-to-face? Of course not. But what I am finding is for a lot of the people, especially under 30, they're fine with that. We could almost argue maybe they're antisocial or they get their social activity differently. But from a work perspective, I actually think they're happier in that type of environment for some of the reasons that I noted. Again, a subject we could save for a different time because it is going to vary on a lot of different perspectives. What I would like to go back to is what I mentioned earlier. So in some of the consultative work I do, families involving the next generation, families creating structures. We've been very active on wealth preservation. I always say the family already has a castle. They need a moat around that castle. And there's various confiscation happening from taxation to, in some countries, and could happen here, civil forfeiture. There's lots of things that could go wrong. So some of the work that I've been doing, like you said, about offshore and having dual citizenship or optionality has been around insurance, reinsurance, private banking. But there's another concept that I'm starting to turn my attention to. I don't know if I'm quite there yet, but I'm getting really close. And you may have a little bit of a conflicted perspective, if you could pardon me being direct, because you have a VC. But could I make the argument, of course I could I make the argument that a I used to say $1 billion family, but now I think that number could come down. But could a significant family of wealth effectively create their own VC? Of course they could. And why not? Let me just give an example. Okay, we're a wealthy family. We're going to invest in 200 different companies, and we're going to put 50 to 100,000 in, which is tens of millions, but not 100 million. Why aren't more families doing that so they could practice the barbell approach, have more control, and engage the next generation in something that they may have an interest in more than it's too boring investing in public companies? They want to be hands-on and ingratiated in entrepreneurship, or at least investing in entrepreneurs. Where am I right and where am I wrong?
So I certainly agree with your thesis, and I personally know a number of family offices that have seeded, owned, right, have VC shops of various permutations. The first thing is you need someone focused on. It's like any other asset class. You never tell someone, I want you to spend 10% of your time investing in oil and gas wells and expect that person to be world class. It doesn't happen, right? So you need to have someone whose main focus is focusing on this ecosystem, and then pay them appropriately. Second is, there's a fundamental tension between the family office culture, which is generally pretty discreet, and the VC culture, which is much more public and transparent. There is an easy way to bridge that, right, which is you can choose to use a separate brand, and I know a number of family offices like that,
yes,
right? And they'll just say, we're backed by a single family office, period, full stop, and they don't even say who the family is, and that helps to mitigate it. And then there's a very small number of family offices that are pretty public about who they are and what they're doing. They have a website, they run conferences, et cetera, et cetera. I know one family that's super public in their name, and they have dozens of employees, but the employees are not supposed to know the name of the backer. It's officially a secret. Now, of course, the employees have figured it out, but that's how they're trying to bridge it. So they're publicizing the corporate name, but not the backer family. And all the employees are very careful not to say to outsiders the name of said wealthy family, which is a non-American family. So it's a little harder in America to find out about them. So yeah, I think that's completely valid model as long as you're comfortable with bridging it. If you look at the Soros family office, some of the other very, very big successful family offices, right, they'll often set up funds where they'll put in seed capital, they'll get some often economics of some sort that are preferential because of their stake, and they'll give the fund manager optionality to grow off on their own, right? Think OXIF, another famous example,
of course,
right?
Yes.
And I think that can be a very successful model.
Yeah, I mean, normally I don't like to give all my secrets away in my more public forums. I save it for my members and my consultative relationships. But if I had to name some of Angelo's big secret 3, it's offshore insurance companies, offshore setting up private banking. Switzerland would be the holy grail, but there's complexities. But I've seen American families, quote unquote, do that. And lately I've been really, really big for all the reasons that you built up into the opportunity, the control, the seeing what's happening with your with boots on the ground, to being able to double up your investment. There's a lot of reasons why. And again, it does not take $1 billion for a much lesser amount than that, how a family could involve the next generation. Hopefully there'll be value added to this endeavor. And again, be active effectively as angel and VC investors. We probably have about 5 minutes left. I'm going to broach a subject that is probably going to get us always both in a little bit of trouble. But again, we're not politically correct, so let's just throw it on the table. We're under 60 days away from election. There's never, in my over 50 years, I'm not young, David, I've never seen anything like this before. There's elements of me that skew to being more conservative. There's some on the personal side that are more socially progressive. And I probably, at heart, am kind of a libertarian, although maybe not the true definition. When I found out that they don't believe in any military presence or close to none, then that's unacceptable. We'd be attacked by other countries. So, but nonetheless, in principle, I hear what they're saying. You, I believe, have strong opinions, probably some that I would disagree with, and that is fine. Why don't I give the floor to you to talk about, from the perspective of technology, disruption, your work with so many millennials and Generation Z, the fact that the immigration policies have gotten much stricter here in the US, things that you touched upon earlier, your thoughts about the election and certain ways that we could be headed, good or bad, from your perspective?
So in a prior life, I was chairman of the only Jewish Republican PAC in the country, so I was very active in Republican politics. But in 2016, I re-registered as a Democrat, and I'm now a member of Innovators for Biden, and I'm the founder of a program for the Biden campaign called Ambassadors at Large, which is for people who want to support the Biden campaign, not just financially, but through leveraging their industry network. And that's driven by the fact that our current president is so manifestly incompetent, right? As a VC, I'm in the profession of assessing talent, and it's obvious to everyone. Every Republican I know also acknowledges, right, that he's incompetent, disorganized, watches TV all day long, on Twitter all the time, cheats on all three of his wives, right? There's a long, long list of how he is not someone you would ever hire to run your business. And my question for my investor friends is, if you wouldn't hire him to run a business and you wouldn't invest in a Trump property, why would you possibly want him to run this country, right? And it's like the question Ronald Reagan asked is, are you better off than you were 4 years ago? So the answer unless you're Jeff Bezos, is I'm worse off. I'm worse off. You're worse off, right? Like we're all locked at home, right? The economy is in a shambles. Our global standing has gone down. And there's no scenario where any private equity or VC investor would ever not fire a CEO who behaved like our current president. So I am working aggressively to try and make America functional again. It is unbelievable to me how many Republicans have gone back on their historical stated beliefs in free trade. Remember free trade, right? Minimal government intervention. Remember that. Transparent and honest government. Remember that. Those are all historical Republican ideals, and none of those are things that our current administration represents. So I have strong sentiments on this, and if you have listeners who are Trump supporters, I encourage them to go invest in a Trump property and see how that goes, because most investors have lost money, and that unfortunately is the history of the family.
Now, a couple of points, and I did want to give David the floor there and not interrupt him, and I think he did a good job from his perspective. And again, many of you know I broadly probably skew to being more on the conservative side. I hear what you're saying, David, and again, some of those are valid points. But let me look at the other point of view. One, COVID-19 happened. It wasn't his fault. Could he have acted earlier and some things be, again, like we spoke about earlier, hindsight's 2020, of course. But okay, let's put the other party in charge come early November. They're adding to the burden of regulation, and for sure, and maybe they have to because of the deficit, our taxes are going to go up and up. Kamala Harris, when she was running, wanted to raise taxes, on people earning $1 million or more to 70%. Elizabeth Warren, I realize not a part of the ticket running now, wanted to do something similar at 90%. That's going to discourage people from wanting to be an entrepreneur, from wanting to come from nothing and to make yourself into something. And often these are people that employ a truckload of people, support communities, are active in philanthropy. And now in a socialistic system, which it sounds like what the Democrats are offering, that's going to reposition the wealth greater and greater. Now, we could argue there's too big of a bifurcation now. Wealthy families should be more active in philanthropy. Yeah, a subject for a different time. Why don't I let you get the last word on that?
We could certainly talk about this at length. I would say we already had Biden as vice president for 8 years, and we did not turn into communist China during that era, right? We were a well-managed, stable, functional country. So I anticipate that a Biden presidency would look not that dissimilar to the last time he was in a very senior political office. And I would be very grateful if we could go back to what America looked like and felt like in 2015.
And we did have a couple of people come on live just a couple of minutes ago. I'm going to make the assumption you thought that this started at 3 o'clock Eastern. It didn't. And we basically spoke nothing about politics. So you come in and must be, what are Angelo and David talking about? This is supposed to be a VC discussion. We had a very deep dive since 2 p.m. Eastern time in the world of VC. David was amazing. It was great. The good news for those of you that came on late is send me an email tomorrow. or actually later today, and I'll have the Zoom recording that simply I'll just forward to you because it's going to take at least 3 or 4 days to get up a little more polished and produced on my YouTube channel. But if you just want to view or listen to the raw interview pre any editing, in about 2 more hours, it'll be produced on a Zoom cloud service, and I'll just forward it to you. So the 2 that came on a little bit late, I promise it wasn't a political discussion. It was a great discussion on entrepreneurship, on VC, a little bit of a look around the world, and we covered so much. David, I wish we had more time. This was fantastic. I really, really enjoyed it. For those that would like to learn more about you, your website is amazing, and perhaps contact you, which I'm assuming they could do from the site. Again, if you could repeat it for those that only are listening in and not live and could see the chat feature, that would be helpful.
Sure. So the website is teten.com, Teten.com, and my corporate site is SOPventures.com, SOPventures.com.
That is fantastic. Everyone, I'm Angelo Robles. I'm the host of the Angelo Robles podcast, and I'm founder and CEO at Family Office Association, a global membership organization dedicated to families of great success and their family offices. I'm very active on social media. Our YouTube channel is simply Family Office Association on Instagram, and you can easily find me on LinkedIn. Our new website, completely updated about 3 or so weeks ago, is FamilyOfficeAssociation.com, and my direct email is angelo@FamilyOfficeAssociation.com. Thank you, everyone, for our live listeners. Thanks for all of you that will hear this or view it in other platforms. And of course, a special thank you to David Teten. Thank you so much, David.
Thank you. Take care.
My pleasure. Bye-bye.